Hey, good afternoon. And I'm just gonna bring this topic up in here today, and it seems like it's always a talking point on what you need to do, and try to get down to some basics in here on what is risk management. And when we look at risk management, you got price risk out there, and you have production risk. I mean, those are really the two basic things. And then how do we manage that risk? And I think when you look at the price risk, and whether if you're a grain or livestock producer, the simplest thing is, hey, we can price forward contract. We like that price. Let's take that on some of our production and eliminate risk. When you get to production risk, and you can also look at price risk here, there's also a number of insurance products out there that you can look at. And on the insurance side of it, I think the thing you really have to keep in mind, okay, is that there's a huge difference out there between what the insurance agent wants to sell you and what you're willing to buy from an insurance agent standpoint. And this was the toughest thing for me to get a handle of when I first got in the insurance business. For them, it's just all about selling premium. Okay, the more premium they sell, the bigger commission check they get. When I got started on this, and this is still my perspective here today, I'm not selling premium at all. What I'm trying to do is sell you, risk protection for your operation. And to me, that's what you need to be after when you're looking at insurance products, is you want to buy the risk protection that fits your operation, not necessarily the most expensive product or the premium that's out there. Then when it's all said and done with, you need to have a plan in place on how to manage this risk, between insurance and, let's say, forward contracting. Have a simple plan, make it flexible. Here on the cattle side of it, and this is just really, come to my attention here the last day or two, and especially talking to producers, how do we manage that risk? Okay. And then it comes down to, what kind of price floor do you want if you're going to be going the insurance side of it? And then at that point is, what does it cost you to establish that price floor to hold your dollars together? On the other hand, your insurance agent is most likely wanting to just sell you the most premium or the highest policy out there. Now, a simple plan to put in place on the livestock side of it is, you buy LRP on a third, you do cash contracting on a third, you do nothing then on that last third. That's a cost effective way to look at managing your risk. And when we look at putting a plan like that together for producers, and this is with the April cattle contract, if we got the LRP on a third and down at a 184 floor here, it was going to run us about $37 a head. If we were up at a 192 floor, though, it'd be running you $73 a head. There, you got to remember, the insurance agent, by selling you that higher price premium, can make nearly 5 times the money as they are on the lower price premium, especially if they get you to buy it on the entire production side. Now we're going to just swing over to the corn market, and the red line on here is 490. Why we have 490, that's about the insurance price right now. Getting down to the last 5 days of the month, it's going to be difficult to swing this thing very much. We heard very often throughout the year how you have insurance. We don't need to market the crop. We have a price floor in place. Now we need to mention to you, you do have your price floor in place. It is at 490. Once that is set, you don't have this thing anymore. As you look at this chart in front of us now, you can make a strong argument that this 480, $495 are good support areas it's held over the last 3 years. But keep in mind, our U.S. carryout is more similar to what it was like in 19 and 20 than what it was the last couple of years. You do have price risk now as we move into the end of October, as this insurance price has already been set. As we want to finish up in here today, we always hear that crop insurance, that's my marketing plan. Well, let me tell you, it is really not your marketing plan. Okay, I mean, it does offer you some production risk. It does offer you some a price floor. But when you look at a marketing plan, you have to cash market this grain at some point. And the other thing now with insurance is, you've come to an end date when this policy is basically mature, with the crop in the bin, the known bushels, and your October price set. Livestock producers, we really like LRP. We think LRP makes a lot of sense as it's tied to the cash market. Another huge advantage with LRP is you pay for it at the end of the period, not at the beginning of the period. Therefore, with higher interest rates, that really makes economic sense for your operation. Another thing for cattle producers out there, keep in mind, this even applies to people who have hay, PRF, pasture, rangeland, and forage insurance. The sign up is here on December 1st. As you look through areas of the country, there's some areas that really make economic sense for you to consider purchasing. There's other areas where it probably doesn't apply to you as much. Feel free to ask us. We'll work through a PRF calculation, for your farm. And then it just comes down to on the protection, okay, and risk management. How do you want to move forward? Do you feel you have risk, or don't you have risk out there? That's a big choice. And then if you feel you have risk, how do you manage that? Do you look at going the insurance route? Do you look at going the option route? Do you look at going the forward contracting route? Again, those are all personal choices that way. We'll continue to build on this, educate you as we move throughout the year. We just thought as this October time frame is wrapping up here to set the crop grain prices, and then the recent downturn on the livestock side of it, it's a good time to visit risk management tools. Have a great day.